All right, everybody, welcome back to another episode of our Ticker Talk format, in which we either talk about individual stocks or entire sectors. Today, we are going to talk about a stock that Andrew actually holds in his portfolio and that we looked at as a community quite recently in the month of, what was it, November? And
Yep.
yeah, Andrew is sort of going to pitch us the idea here. I guess I'm going to play devil's advocate, and Andrew is always interested and very aware of the bear case as well. So I'm sure we'll cover that as well. And we're going to start with an image that I asked Andrew to take before the session. Andrew, what do we see here?
It's all the Yeti products. So the stock we're going to be covering obviously is Yeti. And it's those are all the products that my wife and I own, and there's actually several other products not shown in that picture as well. So we're definitely Yeti and Mystery Ranch enthusiasts.
So after Christmas, how many pieces in total are you going to own? Around 20, I
Uh,
guess, right?
yeah,
Pretty
I'd have to
much.
count 1, 2, 3, 4, 5. Yeah, probably over 20. Yeah.
What do you think? How much did you pay for all of them combined?
Probably too much, but not really. I say
Okay.
that as a joke because Yeti products are
But
expensive, but
but
they're
curious, take a serious guess. So let me guess. How much is that cooler? That must
so
be
that
like
that
three,
cooler my
four
wife got.
hundred.
Yeah, my wife got me that for my birthday. I think it was like a $300 cooler or something. Yeah,
So overall, we're looking at like, I don't know, $2,500.
probably. So $300 cooler, $200 backpack. We have three more backpacks.
All right. I would suggest that we start with an elevator pitch here. Andrew, can you give us the pitch why you own Yeti
Yeah,
in your portfolio in a minute or less, ideally?
Yeah, no, I'll keep it to one or two sentences, really. So Yeti is an outdoor and leisure consumer brand whose primary sales are derived from high-end coolers and drinkware, which act as a lead funnel here in the US. But Yeti is also known for two things: quality and high price point, and as such has built a deep embedment in the consumer psyche for not only quality but also a form of status symbol. So it's kind of playing on a nuance between a status brand, but also a, active sports brand. And they're kind of targeting that space. But ultimately, aside from the qualitative, the quantitative side of things also look great as well. So low valuation, great balance sheet, solid management, a long-term growth prospects as well. So all the boxes are kind of checked.
Awesome. Let me just say that everything we discuss in these conversations is supposed to be entertainment or should provide entertainment value, and is certainly not to be confused with investing advice. Obviously, we encourage every single one of our viewers to do their own due diligence and maybe most importantly, consult with a financial advisor if you consider making actual investments. So I think that's something we definitely have to stress. I'll get back to the stock chart in a second. I guess we should start, and you covered that mostly already, by first of all understanding what the business is actually about. So I decided to include this sort of, it's not really a stock image, but it's an image taken from the most recent investor relations presentation from Yeti. And I think it shows two of their products at least. Because what I noticed, Andrew, during our discussion in the community is that especially outside of the US, Yeti is not as established as you might think.
Mhm.
Some people have never heard of the brand, right? So, how would you define the target audience?
Definitely more of an affluent consumer base. And I'm not saying, the top 1%. I'm certainly not the top 1%, but certainly middle class, upper middle class is probably the prime consumer base. Also customers who are very serious about the quality of the product that they're buying, meaning they're willing to pay up a little bit for the quality. I mean, similar comparisons, obviously different, but similar comparisons would be something like a Nike or a Lululemon, right? They're kind of known for their quality. Certainly, you could find the Chinese knockoffs or whatever, but that's not really the primary consumer base. And then also because it's kind of in this outdoor niche, it's very tied to hobbies and certain things like that and certain experiences. So
Mhm.
even though it's maybe cyclic or it's discretionary in the sense that people don't have to buy the items, because it's very specific to certain outdoor activities and certain hobbies. You still don't really have that cyclicality, that's often embedded in certain discretionary items. So another good comparison, which actually I think we'll get to later, is something like a golf company, right? So something like Acushnet Golf Holdings, I believe it's called, ticker symbol Golf, right?
Mhm.
It's kind of that middle upper class consumer, and you're going out and you're specifically searching for these items typically, and you're specifically searching for the quality and willing to pay up for it. So yeah, that's kind of the consumer that they're targeting there.
Yeah. What I'm thinking of here are two things, and I'm going to show you the slide that I want to talk about here. So I would say the unique selling point of Yeti is that they sell products of extremely high quality that will last pretty much forever, or at least for a very long time, right? So when you buy a cooler like the one shown in your image, you don't expect to replace that, I don't know, within the next 10 years, I guess. Is that a fair statement to make?
Yeah, certainly.
And as an investor, we generally like to own businesses, considering all else equal, who have recurring revenues, which would not be the case if you own a piece of equipment bought by a company for multiple years before replacing it, right? But then on the other hand, and this is a screenshot taken from their regular website, you could argue that they are building an ecosystem, and you and I have discussed that. I'm not sure if I fully like that term with regard to Yeti, but I guess what you have to understand as someone who is considering investing in Yeti is that they have a very wide product range, right? So actually buying one item might be sort of your entrance into the Yeti ecosystem. And when you are a satisfied customer considering the quality, you will add new things to your. It's almost a collection, right? Do you consider
Yeah.
your Yeti stuff a collection?
Yeah, certainly, and I think it's because it's tied to that price point. So you're willing to part with kind of an upper range amount of dollars for apples to apples comparisons to other products out there. So you certainly value it a bit more. Obviously, it's not an ecosystem, something like Apple or whatever, but it is the kind of known in the psyche of that like Apple quality, right? But so yeah, certain things that I touch on first is kind of that lead funnel. So they do partnerships with companies. So maybe companies are, and this is actually ironically how I got introduced to Yeti maybe 4 or 5 years ago. It was actually my company for Christmas gave everyone Yeti cups with our company's logo on it. And that's kind of how I got introduced to the company. And so, whatever that investment to Yeti would be, that acquisition cost, every time I buy a Yeti product after that, they come out with something new, right? That acquisition cost is virtually zero. So that's kind of a benefit to it. But then also because of the niche that they're operating in, first off, cups, right? You might lose lids, you might forget your cup somewhere, so you're constantly replacing that. Especially like us in the construction industry, the amount of time I've seen people, I need to go buy another Yeti cup because they've lost it or whatever. So that's kind of funny. But then also because it's kind of outdoorsy, so right, the coolers. So Yeti has been asked about this a few times in the past, and obviously they're still early in their growth, I would say globally. Obviously a bit more saturated than in the US. But so there is still growth for them, for new entrants, for new consumers, I should say. But even the existing consumers, what they're doing is it's called their Yeti rescues. And what it is because, for example, the coolers, let's say you're going fishing or, you're taking it to the beach or whatever, it gets beat up, it gets old. And let's say you want a new one, or you want a new color, or you want a new style that's come out, right? What you can do is Yeti actually will buy that back off of you, not obviously full price, but they'll buy that back off of you, and you can use that as a credit to something new. And then they sell these Yeti rescues back to consumers, so cheaper than full price, but obviously at a markup of what they paid to get it back. So it kind of causes this loop of recurring revenue. Obviously, it's not like a SaaS. It's not the highest quality business in the world. And obviously I've spoken to you about that as well, and into your community as well. It's not the highest quality, business in the world, but it's still a pretty quality business trading for what I feel to be much cheaper than a quality price. So
Yeah, that makes sense to me. I also decided to include this table taken from the 2023 annual report. So I think they wrap up their fiscal year early in the year, right? So that table might be 6 months old, but it gives you an idea of how large the different categories are, and the drinkware category certainly makes up close to 2/3 of overall revenue, right? And coolers and equipment the remaining third. I would love to see a more nuanced breakdown of what each category consists of.
yeah.
I think, like earlier I said, some people might not be familiar with Yeti in the first place. And I think even of those who are aware of them, many will only think of the tumblers, right? And as we've just seen, there's much more to the Yeti ecosystem.
Yeah, so in the drinkware space, for example, just to keep it very simple, right, drinkware, you're obviously thinking of the tumblers, but drinkware also consists of their lids. They sell certain colors for the lids. They sell a vast different there's a vast variety of different tumblers, different sizes, different product lines themselves, and now they've also gotten into, call it, barware set, right? So they have mixers and they have shot glasses, right? Not things that you would think of as tumblers, but that's obviously sold under drinkware. They even came out with a coffee pour over. They have a Yeti French press. Once again, not really something you would typically think about, but also does fall under that drinkware category. So yeah, I would love to see a further breakdown as well. The one I'm most excited about, though, and this is where I think a lot of their growth will probably come from moving forward, is actually backpacks and certain travel items such as luggage and different things like that.
Yeah. And the other part I wanted to highlight here is that significantly more than half of their total revenue actually comes from direct to consumer sales, which is also something I always like to see as an investor, because those are usually higher margin sales than those where there's a middleman, right? So I guess the majority of that is via e-commerce, but I think they all also operate around 20 stores. I think. Do you know?
Yeah. There's none near me. They're more towards central United States, more a little bit out west, South United States. Yeah.
So did you order all of your equipment online?
Yeah, all of it's through their website. I've never bought anything in store. Yeah, it's all I may have gotten one tumbler in store or something through one of their partnerships, like REI or something. But yeah, no, the 95 to 99% of all the products have been direct to consumer. And what you're seeing actually is, as a portion of their revenue, you're seeing direct to consumer take over versus obviously things like wholesale. And that's, management's kind of talked about this, and this kind of goes back to one of my original points. It's that consumers are, like, it's a very intentional purchase. So customers are actually going out and seeking specifically Yeti products. They're not walking in a store saying, I'm looking to buy, a tumbler or a cooler, and say, oh, you know what, I guess I'll get a Yeti. They're actually searching Yeti coolers because they want that, so that's obviously a good sign to see.
Yeah, that makes sense. So let's quickly take a look at the stock performance. So I decided to include a stock chart that covers the last 5 years. And over the last 5 years, the stock actually has performed that well. It only compounded at a rate of 4.2% over the last 5 years. However, it's down 61% from the peak in late 2020. And we'll, of course, take a look at the current valuation multiples and also share a valuation approach that I've come up with a little later. But what makes you confident in the long-term performance of Yeti, considering that the last 5 years haven't been great in terms of stock performance?
Yeah, so in terms of stock performance, the business performance has in fact been very good. In the past 2 years, they had kind of a 1-2 punch. A certain key player at the company ended up leaving. That was actually to move back to Boston, which is where he was from. And then right around that same time, they had a recall of their best selling coolers, of their soft coolers, I believe it was. So that obviously kind of had an issue on the or an impact on the financials for a little bit there. But yeah, I mean, overall, really primarily you're seeing multiple contraction. And that's not really a knock on the actual underlying business performance. Also, what I will say is this isn't like an idea of, something like a 20-year hold, right? You and I have talked about this before. I have kind of two buckets. I have long-term buy and hold compounders that I'm kind of looking 10, 15, 20 years out. And then I have kind of these 1 to 5 year plays, depending on when the valuation re-rates. And right now, I think Yeti is a quality company. Right, I don't go fishing for cigar butts or anything. I always look for quality companies. But I think maybe future growth, you might get low double digits, which is certainly good. But I think you'll also probably get a few percentage points on top of that with a multiple re-rating, and that could give you very, very attractive returns, especially depending on the velocity of those returns or the time frame of which that multiple expands.
Yeah, yeah, awesome. So you were just talking about the fundamentals of the company that throughout that 5-year period have developed well. And brings us to the financials of the company. What you can see here is how revenue and free cash flow developed over time. So ever since 2016 to today. If you take a long-term view, revenue is certainly trending upward, up from, say, around 600 million back in 2016 to more than triple that today. So that's certainly a very good performance. And the 5-year compounded annual growth rate of revenue is actually 16%, which is certainly very pleasing and something investors, if you leave valuation aside for a second, should cherish, I would say. Free cash flow margin stands at around 9%, and the free cash flow generated by the business over the last 12 months was 160 million. So if we think back of the market cap that was displayed in that Google screenshot, which was around 3.5, we're looking at around a 20 times free cash flow multiple, right? I'm already talking about valuation, which I actually want to get to later. But now I said it out loud, you might as well comment on what I just said. So that doesn't strike me as cheap.
No, I know. So I don't normally like to use. It depends on the business and where they are in their cycle. I know this is where you and I typically disagree. I like to look at free cash flow to obviously make sure there's not massive discrepancies, but to use free cash flow as a valuation model is not my favorite. And there's certain changes in inventories and working capital and stuff that can really throw off the free cash flow. And that's kind of what you're seeing. The company is cheaper on probably a fully realized basis, and that's kind of where my valuation falls is a low teens multiple.
Yeah, that is something I noticed too. So what you can see on screen right now are the different margins Yeti produced over time and also the return earned on investments. And I noticed that the operating margins were definitely higher than the free cash flow margins. And I guess that has something to do, as you said, maybe with inventory management, but also them investing into the company's future, right? I'm not familiar enough with the company to know where exactly they are investing most of their free cash flow. I could imagine certainly branding, but then also the international expansion that we're going to talk about in a second.
It's also building out new suppliers. So I'm not sure if we'll get to it later, but about I think 40% of their production comes out of China right now, and they're trying to get away from that. So that's obviously kind of a large part of where their investment is going as well.
Yeah. So you would argue that ultimately at steady state, this business is going to post higher free cash flow margins than 9%. And I can get behind that as
it's a quality brand. Yeah.
Especially if we look at the gross margins, which sort of reflect what you are or were describing earlier, right?
Yeah.
Certainly quality brand, high ticket pricing, people are willing to pay it, and we see gross margins above 50% over the last 12 months, even 58%, which I find pretty amazing considering the business that Yeti is operating.
Yeah. And management's talked about getting that upward to probably 60% plus over probably the coming, call it 5 years.
Yeah. I'm not sure how much room for improvement they have in terms of gross margin. Again, considering the category they are
It'd be
operating.
category mix is going to be your main thing. So talking about that lead funnel, right? They have some kind of, call it maybe smaller margins. I would assume based on kind of the trend of the business. I don't think they've technically said this, but you would assume it's going to be product mix. So they probably have slightly smaller margins on drinkware and higher margins on things like coolers and backpacks and kind of their new innovations. They'll probably post higher margins on cast iron skillets and stuff like that. They're selling for $300. So they probably post the 60% margins on those products.
Mm-hmm. Yeah. What we see towards the bottom of this slide here is the return on invested capital earned by the business, and the mean over the last 8 to 9 years was actually 28.5%, which again emphasizes or supports your thesis that we are looking at a quality business. I agree with the overall assessment that we're certainly not looking at the highest quality business out there that is publicly traded, but I also said that obviously the benchmark when you only look at publicly traded companies is a little tougher than, say, all the businesses operating in the US. I would say we're probably looking at a slightly above average business here, which is certainly reflected by the numbers. So I think all of the numbers we looked at so far, revenue development, the margin profile, especially on a gross margin level, we have to keep in mind that we are selling physical goods that are not necessarily perceived to be luxury. It's not like in fashion you can, I don't know, charge thousands of dollars for it, right? So I think they're definitely flexing their pricing power to the extent they are able to. I'm not sure how much more room they have there. Maybe if they change the category mix, that makes sense to me. But I think it's definitely a business that is performing well. And just looking at the numbers, to me, it seems like management has also done a very good job here moving the business forward, I think.
Yeah.
I have two more charts on capital allocation. So if we look or consider the growth potential for the business, I guess one driver would also be buybacks. And we see that over the last 2 years, management has started making use of that capital allocation tool more frequently. So back in 2020 and now also in 2024, they actually spend around 100 million on share buybacks. Is that part of your thesis too?
Yeah, I mean, because of kind of the state of the business, or I should say kind of the inning of the growth, I wouldn't put as much emphasis on buybacks as something maybe like a Boston Bear or something like that. But certainly, I mean, at today's valuation, I'm glad that they're buying back shares. I obviously wouldn't put any weight on that if shares were trading back at their normal valuation, though. But there was something I was going to say, but I can't remember it right now. So keep going.
Doesn't matter. So as an investor, when we start valuing that business, we have to think about growth. And in your summary towards the end of November, you shared that you think there are 3 key growth drivers, them being international expansion, product innovation, and acquisitions. Let's talk about them one by one, starting with international expansion. What can you tell us about Yeti's ambitions here? And I included one chart from their most recent investor relations presentation as well.
Yeah, I honestly don't think I can say much more than what the chart presents there, but it's just kind of their international mix, right? It sits at roughly 18% today. They're obviously early, entering into other countries outside the US. And so you would expect that they kind of put that as the benchmark. And here's where I was talking about Titleist, and the Titleist is owned by the Acushnet Golf Company there. But yeah, so you can see these more typical mixes of a certain kind of brand or consumer product kind of in the space that they're operating in with that certain kind of mind share. You would think that it should be upwards of, they're showing anywhere between close to 40 and over 50%. But even if they can get that to call it 30%, right? That's obviously nearly a double from their international business right now. And then obviously if they keep growing the United States business as well simultaneously, I mean, they can definitely post some double digit growth, especially if they, buy back shares or whatever, multiple re-rates and everything. So yeah, I think the returns moving forward are definitely there. Oh, and that's what I was going to say earlier was we're talking about the quality of the businesses. This is just something I wanted to mention real quick. Not specific to Yeti or anything like that, just in investors in general, there's kind of, we categorize in two separate buckets, like value and then also like the quality of a business. But there should be, if we're kind of thinking about investing, there should be like this quality to value ratio. And right now, I would say that in my bucket of companies I'm finding, the quality to value of Yeti, right, is probably the cheapest that I can find within my circle of competence today. So it's not the highest quality business, and it's certainly not the cheapest business, but it's probably, we have the price to earnings to growth ratio. There's also a kind of a quality to value ratio that we should probably consider as well.
Yeah, very well said. And I don't have anything to add regarding the international expansion opportunity. I think these two bar charts here summarize the opportunity quite nicely.
Yeah.
What I will say is their outlook for their 2024 fiscal year isn't something that blows me away. So they're guiding for sales growth of around 9%. And as you said earlier, for you to earn a satisfying return, you also have to bank on some kind of multiple expansion. It doesn't have to be crazy multiple expansion, but some to get to that low double-digit return, right?
Yeah, low double digit over many years, but I wouldn't doubt if they can post a year or two, or even a quarter or two of really stellar performance. You'll get that multiple re-rating very, very quickly.
Yeah. I think we mainly covered the second growth driver, product innovation already. So let's just jump to the third one, acquisitions. That is something we haven't really talked about, and I decided to include a backpack in here from a different brand. Tell us a little bit about that.
Yeah, so that's, I think, their most recent acquisition, which was Mystery Ranch. So prior to that, they did Butter Pat, which is pretty much the leader in cast iron skillets. So what they're doing is they're acquiring companies in very, very, very specific niches, and like the most quality company in that specific niche. So it's not such a large niche where you're going to have these massive players coming in, but they're getting it at a good enough, obviously, price where they can get a good return on that investment. But then also they step right in as, they rebrand their products into Yeti products, and then they step in as being the quality top player, right? Because they're just acquired the top player essentially in that niche, but the niche is kind of so small where Yeti is able to acquire the top player there. And that's really what they're focusing on. So they want to get into cookware as well. They're trying to be kind of like a one-stop shop for like your kind of like not everyday needs, talking, toiletries or anything like that, but your everyday discretionary needs, so to speak. And so obviously they also acquired Mystery Ranch, and Mystery Ranch is pretty much the leader in kind of outdoors backpacks, but they're also the leader in firefighter and military backpacks as well here in the United States. Well, backpacks and duffels and other bags of that like. And so what they've decided to do with a brand like Mystery Ranch is to keep the because they're kind of very well known in like the.
I was about to ask you why they decided to take a different route here.
Yeah. So the military, firefighter, and there may be another category that I'm forgetting. They've decided to keep the Mystery Ranch branding there. They're not going to change the branding at all. And that's because they're so deeply embedded as being, Mystery Ranch being the quality name. I think they fear that if they switch it over to Yeti, they're going to say, oh, this corporate coming in and changing things, and they're going to go search elsewhere for their products. They're so deeply embedded in that mind share that's such a valuable it's such a valuable piece of the acquisition that they wouldn't want to change it. On the consumer side of things, though, so hiking and everything, I think Yeti already has that mind share embedded in. So yes, people know of Mystery Ranch in the hiking space. So my wife and I are avid hikers. We obviously know of Mystery Ranch, but we also, because we operate in that outdoors category, we also associate Yeti with quality already. So I think in that sense, they're changing, the everyday packs or the travel packs, the backpacking backpacks, that they're converting those over to Yeti and probably charging slightly more for that Yeti brand, but it's really nothing crazy. But they actually did just release, I think 3 days ago, maybe they just released their first collaboration with Mystery Ranch under the Yeti brand for these 27-liter backpacks, and they're selling for like $275. So probably posting some pretty fat margins on that.
Yeah, that's interesting. Do you know if they sell Mystery Ranch backpacks on the Yeti website? Probably not, right?
No. So they still operate. So actually, I was going to say ButterPat. ButterPat is completely inoperational. If you go to their website, it's just fully under the Yeti brand. Once again, kind of known because people know them for their drinkware. They know them for other cooking items. So it kind of made sense to rebrand there. But yeah, no. So Mystery Ranch still operates its own website entirely if you want to buy Mystery Ranch products. Moving forward, I don't think, like I said, consumer items for Mystery Ranch is going to be that's rebranded on the Yeti website. However, like I said, military, firefighter, stuff like that is going to be operating kind of almost like as a standalone entity under the Mystery Ranch brand. And so, but yeah, so management's talked about backpacks being like a multi-billion-dollar category that they think they're going to be pretty successful entering into, taking some really good market share there. But then, yeah, there's other categories that we're probably not thinking about right now that they can probably expand into via acquisition. And this is also kind of part of my thesis, right? So we're getting it at, like I said, a low teens multiple on a forward basis, low teens multiple. And you don't really need much to go right at that valuation. But then your call option, your upside there is if they do really hit it off in one of these new categories that they're entering into. I mean, they could raise their business, double their business over 5 years or whatever, just by entering into the right specific category. And so that's nothing I would be willing to pay up for, but you kind of get that call option for free, which is very nice.
Yeah. So I have a couple of thoughts here. Let me try to structure my thinking a little bit. So what I'm hearing is that going forward, acquisitions are probably not going to be an incredibly important growth driver. Rather, probably the acquisition point here is sort of tied to the product innovation point.
Yeah, I would say it's right. Yeah, I would say it's product innovation and acquisition are probably joint at the hip. The only difference would be product innovation. Okay, is there a clear winner in the space? Is there a clear quality player in the space? If not, then we will do that innovation. And also the innovations kind of already work with products that they have. So for example, the new pour over coffee lid, right? That is specifically designed to fit on all of their tumblers. But yeah, so if there's already a clear winner in a specific space and a specific niche, that's when they'll probably look to the acquisition.
Yeah, and to a large extent, if they start to then embed the new product category under in the Yeti brand, they are just purchasing the know-how, right? That's how I would think about it. And then secondly, I wanted to bring up the point that you made with regard to a new category potentially being providing massive potential for Yeti. I'm not so sure about that because if we think of the backpack category, for example, obviously, I don't have any numbers at hand, but I would imagine that the backpack category worldwide is huge, but I would assume that many of the categories that Yeti could expand to are also going to be extremely fragmented markets, right? So I'm not sure what the market share of the leading backpack company would be, but I would imagine it's probably not double digits, right?
Yeah, you're probably right, which is why I said it's kind of a call option. It wouldn't be
Yeah.
something I'd be willing to bet on. And that's why I was very specific with saying that it's potential there, right? So now Mystery Ranch gets extra distribution, which they didn't have, global distribution, which I don't believe they probably had anything set up that well.
Yeah.
So you could see them steal some more market share in a specific category by partnering with Yeti and joining the Yeti team there. But once again, I really stress the point. It'd be more of a call option than anything I'd be willing to actually bet
Yeah.
on in my investment
And all I wanted to
thesis.
say that my hunch would be that, say, revenues doubling over 5 years just by adding one spectacular categories is probably a bit exaggerated.
Correct.
But I agree with you that it's certainly one of the growth drivers, going
Mhm.
to be one of the growth drivers going forward. Let's talk
Yep.
about the risks here. So I think we both stressed that Yeti is not the best business in the world. Nonetheless, we believe it's probably a high quality business worth putting on your watch list. However, there are, of course, headwinds, risks, problems to be aware of. And you have identified three that you wanted to stress here. The first one would be competition. And one thing we discussed early on in the community was that nowadays the Stanley tumbler seems to be, let me say, on vogue, especially among
Yeah.
younger generations. How is a new brand, and I think Stanley, that's not really a new brand, right? But their success in that category, I think, is certainly something that is sort of
Yeah.
a trend. How is a new player not going to take away market share from Yeti once Yeti loses appeal?
Yeah. So the Stanley thing's funny. So that's something that the trend kind of picked up like early last year, I want to say. And this was also while Yeti was kind of seeing other issues as well. So the stock got cheap right around this time, and I remember I took a step back and I said I want to see kind of how this is going to affect them. And I really want to see if the Yeti consumer is as strong as I believe them to be, or are they more fickle? And what you saw, and management talked about this as well, and analysts asked specifically about the Stanley competition and stuff. You didn't really see any market share be taken away. Once again, it goes back to that core consumer, right? The core consumer wants this quality brand name. Stanley isn't really a quality name, and especially in this space they do like these, and they're very, I'm sure they earn a very good return on their investment with this, but they partnered through Target. They're kind of targeting like that, you know middle class soccer mom type thing that wants, or that teenage Starbucks girl, right, who wants that new limited release of the Stanley Cup. It's more of a collector's item than an actual everyday use for the specific consumer. Obviously people use the Stanley Cups every day. But yeah, I wouldn't say that consumer base is really the core Yeti customer. Do some maybe on the bottom fragment people try Yeti and say, oh, this is kind of expensive, I don't want to, and then they go to other brands like Arctic or whatever? Yeah, I'm sure they do, but their core customer is actually very, very loyal to that quality and to
Mhm.
that Yeti brand.
Yeah, that's a very good point. And that brings me to one last aspect I want to bring up with regard to that particular risk. So what they write in their annual report is, in terms of competition, is competition in our market is based on a number of factors, including product quality, performance, durability, styling, and price, as well as brand image and recognition.
Yep.
And my hunch would be, and I think I expressed that to you as well, that in this particular category, consumers are more loyal than you would think. Certainly more loyal than in the apparel industry, where like to this date, I have made an investment in the apparel industry, but I try to avoid the apparel category because consumer taste is so fickle. And I don't think that's necessarily the case here. You certainly have, as we now said multiple times, a loyal core consumer base, and then everything you gain on top is a bonus, I guess.
Yeah, and it goes back to that customer acquisition cost, right? So something to consider. So if we think of like the bottom, percentile, that tail end of the consumer base, people might get a Yeti cup as a gift or whatever, and they don't go out. I have plenty of friends that don't go out and buy any Yeti products, right? They'll get plenty as gifts and they love the product, but they're not going to go out and shop for it. So certainly they may buy one Yeti product or whatever, but they're not really loyal to the Yeti brand. And those are the consumers that will make the one-off purchases, right? And that's kind of it. The real return that Yeti sees on their investment are those Yeti consumers that come in, and then once they've acquired that Yeti consumer, they don't really have to, like I said, spend anything extra for them to start buying other items under the Yeti umbrella there. So that's really the core customer that Yeti's after. And so if they lose, the bottom percentile to competition like the Stanley Cups or whatever, I think they're probably fine with that, because those Yeti consumers probably weren't going to go out and buy other Yeti products without them having to advertise like crazy for those consumers anyway. So yeah, I don't think it's really the end of the world if they lose some. But going back though to the brand image and recognition, that's going to be something, and quality, because they're known for the quality. That's something where if their core consumer starts to view them differently or to get upset with certain, maybe new innovations or, corners that are being cut or whatever, that's something that would be very detrimental to the brand.
Yeah. And I have one question for you here in terms of product quality, because that's also the first factor mentioned by management here. So at first glance, when you look at a company like Yeti, you would think that they are just selling a commodity, right? But I think you have expressed that from your experience, their product is just superior to that of competitors.
Yeah.
Is that correct?
Yeah. Like I said, their closest competitor in many things would be something like Arctic for coolers or whatever. And, they're a lot cheaper, maybe slightly less quality. But yeah, I mean, on an apples to apples comparison of just purely quality, it's really, really tough to compete with Yeti. So that would be one of the main things that, like, when you go out and me as a consumer, if I'm going to buy something Yeti, I don't really have to. I do watch reviews and stuff just because it's fun, but I wouldn't have to know that the product that I'm paying for is going to be of top quality, right? Like, you just know that if I'm buying a Yeti product, it's going to be top quality. And that is a very, very, very valuable asset for Yeti to have in the human psyche. But once again, if they start coming out with bad quality items or maybe not top quality items, that would certainly be extremely detrimental to the brand.
Yeah. Do they have any like secret ingredients that make them create these super high quality products? Because
Probably not.
I wonder what it is, because, and we're going to talk about that in a second, they are, as of today, producing most of their drinkware, I think, in China. So I would think that a competitor could probably develop similar relationships with suppliers from the Asian world to offer a similar quality product. So I wonder what it is. But
so let me say this as well. Maybe there's more value in the perceived quality of the brand than the actual quality. So they are top quality. But if you do a like-for-like comparison, for example, that brand Arctic actually has very, very similar quality products. They've been back and forth with lawsuits over the years too. But this brand Arctic is valued, maybe call it half of the price of a Yeti cooler, the Arctic cooler. For apples to apples comparison, very, very similar quality. But that perceived quality of owning that Yeti product is extremely valuable to them. It'd be no different than Apple. Like, I mean, Apple was way ahead of the competition especially with their iPhones years ago. But I mean, nowadays you can get like way higher quality smartphones than Apple has nowadays, but they still charge 2 or 3 times more than other competitors, and people are still willing to pay for it. And people, even though the tech might not even be up to snuff with the competitors, people will still say Apple has the superior product when it's been proven time and time again that's actually not the actual case anymore. but it's so embedded in that psyche. And as a consumer brand, all you really need is that human psyche. Once again, Yeti does have superior products, but that human psyche as well is a massive asset to have.
Yeah. Yeah, it really helps to understand human behavior and human psychology in particular.
Mm-hmm.
Because I think there are plenty of studies showing that as you pay more for a product, the perceived quality goes up, even though the
Yeah.
quality itself objectively hasn't really improved. So
Mm-hmm.
yeah,
It's just like stocks. It's just like stocks. Bitcoin's at over 100,000 now, so it must be the future. So go out and buy yourself some Bitcoin.
Yeah, good point.
Yeah.
The other risk you want to bring up here is supply chain risk. So what I noticed when I listened to the Q3 conference call was that management was really trying to stress very actively that they are very actively trying to move production outside of China, or at least parts of it. Is that really a risk? How do you think about that?
Yeah, I mean it is. It is and it isn't. So as of now, it is because the numbers don't add up. So this is going back to the Trump and tariffs and everything. Once again, I'm not an economist. I'm not one for speculating on what a president may or may not do. But assuming, let's say, he does charge massive tariffs on imports coming in from China, that would obviously hurt Yeti's bottom line. And they probably, like you said, they're probably stretched for pricing as it is. So it's not like they could just make that up in the pricing. So it would certainly hurt their margins. Now, Yeti talked about, okay, well, this is just imports coming into America from China. We can either reroute those imports, which obviously would kind of hit margins, or we could just send them straight. Now that we're driving international markets, we can just, maybe sell from China straight to China, or we can sell from China to Australia or whatever else it might be and not have to worry about those tariffs. Yeah. Right now, the numbers don't line up because it says right here, 40% of our total cost of goods is tied to China. Their international business is not 40% of their business. Now, 40% of their business and 40% of their cost of goods sold, you could say, okay, everything that's produced in China, just ship it international, and then everything else will import into America from anywhere else or make it right here in America. So as you see, it won't be an issue as you see the cost of goods sold from China coming down as a percentage of their total mix, and then a total mix of their international business going up. Once those two numbers kind of hit an equilibrium, it won't be an issue. As of now, though, it is definitely a risk to the business that they're avidly working on, obviously taking that risk out, so to speak.
Yeah. And then the last one would be saturation. I think we mostly covered this one already too. Mm-hmm. I think the point to be aware of here would be that you're only going to own so many different Yeti products. The US market is probably already quite saturated, and the international opportunity is going to be a major growth lever. I think that Yeti needs to pull, or the management needs to pull, if they really want to achieve that low double-digit growth, right? Which I think brings us to valuation. So first of all, let's take a look at the valuation multiples. So that's a Coifin chart, which shows that over the last 12 months, or on a last 12-month basis, we're looking at around, as I said earlier, a low 20, 21 times multiple. On a price to earnings multiple, we're looking at a cheaper multiple. On a last 12-month basis, we may be looking at a cheaper multiple on a next 12-month basis. So the PE would be around 18 times. And where the stock really looks cheap would be on an enterprise value to operating income multiple, where we're only looking at a 13 times multiple. I think you mentioned that the balance sheet of Yeti is extremely healthy. Are they sitting on a net cash position?
Yeah, they're saying, if I'm invested in a company, they're sitting on a net cash position. And actually management has, so when they first went public, they were not. And they've been not only, increasing their cash flows, aka increasing cash on the balance sheet in turn, but also paying down debt as well. And they're continuing to do that. So I think prior to going public, maybe, you might have had PE kind of leverage up the balance sheet to go public. But since then they're working on cleaning up that balance sheet. Cleaning it up, it's a very, very clean balance sheet, but they're not net zero debt, right? Or they are net zero. They don't have no debt on the balance sheet. They do, but they're in a very, very healthy net cash position. But yeah, so I mean, going back to the free cash flow not seeming as cheap either.
Mhm.
Which is why I say I wouldn't worry too much about the free cash flow. And I would focus more on like the operating earnings or the actual net income. And that's because so if you think about it, the free cash flow like being margin being down or whatever doesn't make sense if you think that the price to sales or EV to sales is at its lowest multiple and the gross margin is essentially at its highest margin rate right now. Like
Yeah.
those two can't be true if the actual core margins of the business haven't increased. So once again, going back to the free cash flow, it's kind of skewing the business a little bit, whereas the actual operating income or the net income is probably a bit more reliable today.
Yeah. So actually just check because I wasn't sure, but I think when we looked at it, so that was in November, the stock was a bit cheaper than it is right now. So right now we're looking at a
Yeah,
share price of around 42 US dollars. And I remember when I thought like the price is sort of enticing was in the 36, 37 US dollar
yeah,
range. So the price has come up quite a bit. So let me share some thoughts on valuation that I conducted. So what I was thinking is based on 1.8 billion in revenue, if we assume an 11% margin, and you might you might assume a higher one, but that's the highest I would feel comfortable with considering the business Yeti's operating in. And that's also their mean free cash flow margin over a very long time. So based on an 11% margin, the business right now would post around 200 million free cash flow. I was then assuming the company to grow a free cash flow by 12% for the next 3 years, and then another 10% in year 4 and 5, which would bring you to 340 million ballpark in, when would that be? So 2029. Based on the 200 million US dollar free cash flow, we would be looking at 21.4 times. Oh no, that's not correct. Actually, noted down. That's based on the 9%
nine
margin
percent.
business actually
Yeah, so it'd
posted.
probably be like you said, like 18. I think was the number, but
Yeah, yeah.
yeah.
But basically, I was assuming an exit multiple in 2029 of around 15 times, which again may be a bit conservative, but I wouldn't want to count on a business like Yeti, where we said, yeah, it's a good business, but it's not like super high quality business to trade at a 20 times multiple. I wouldn't want to make that part of my thesis. So I really like to keep it conservative here. So I was assuming a 15 times multiple. And based on these two assumptions, so 340 million free cash flow in 2029, multiplied by 15 times divided by the shares outstanding, you would get a share price of $59 a share. So that would be 50% upside. However, on a compounded annual basis, that would quote unquote only be a return of around 8%, which might actually beat the market over the next 5 years, looking at the current
Yeah.
valuation of the S&P. But nonetheless, it's not a return that would overly excite me. And again, keep in mind that we saw quite a run up in price here. So I was assuming 40.5% as the start per share as the starting price in my model. Where do you disagree with me here?
Just the valuation process in and of itself, but once again, using kind of free cash flow and discounted cash flows or whatever, that's perfectly valid. Probably the exit multiple too. But once again, I agree. It's not so your multiple. Okay, so here's where I think that probably the biggest discrepancy would be in how I'm framing an investment thesis, right? So your exit multiple of 15 times, fair. That makes sense. But if we're acquiring it at a sub multiple, or even if we call it 15, if we think that that's kind of our low side, right? So on the low end, you're being conservative. On the low end, we're only getting a 7.5 to 8% return. That's not bad if our upside potential is far more, right? So it's kind of going to like a risk reward. So not using Yeti as an example, changing over to like Boston Bear. You and I have talked about this outside of this before, but just in our own time, where it's such a large portion of my portfolio, not because I think the future returns are so high, but it's that the downside in my perception anyway, is so low, and the return opportunity compared to that risk is just extremely attractive. And that's kind of where Yeti, I think, lies today. And also, once again, we're maybe valuing it 5 years out, but you might get a multiple re-rating from, call it the earnings ratio of 14 on a forward basis today to maybe 18 or 19 times in a couple of years, and then maybe you choose to exit at that point. So it's not that I think your valuation model is wrong. Certainly you and I think never value businesses exactly the same.
Yeah, that would be true for all investors, right?
Yeah. But that's
100. I was about to say, ask 100 different investors on what they think a particular stock is worth, and you will get 100 different answers.
Yeah, exactly. So, but I think ballpark, just that I think it's a quality name that's probably, I think, cheaper than it should be, is really where the thesis comes into play. And I think based on where I see the company going over the next couple of years, I think the market, kind of going back to human psychology, I think the market will probably re-rate it faster than maybe many others are anticipating. And that's all. I mean, it's a very simple thesis. And right now it's about maybe 5 to 7% of my portfolio. And we'll see. If it, obviously, I'd love a single digit earnings multiple as well. Unfortunately, that hasn't happened recently. So
what kind of forward earnings multiple would you consider selling? Because earlier you said that's not going to be, Yeti's likely not going to be a long-term hold for you. So
yeah, I'd probably, depending on other opportunities and stuff in the market, I'd probably, and depending on how quickly we get the re-rating too is also a big factor. But I mean, high teens, low 20s on a forward basis, but that's also if I have an opportunity out there. I mean, if I don't have an opportunity, maybe I won't sell. But I mean, certainly if it were to get to like 25 or higher on a forward basis, it's a quality name, yes, but it's not like we said, it's not a software, it's not a SaaS business or anything like that. It's not a Meta. So I probably wouldn't hold at that point. Now, could it go from 25 forward earnings to 50? Certainly, and plenty of my companies have done that before, unfortunately. But yeah, that's probably where my mind's at currently.
Andrew, I think this was a great conclusion. I don't have much to add. Certainly, in a stock you don't hear a lot about on financial media. I feel like it's a stock that is not very well covered, and I hope
a lot of mine are not.
Say it again.
I said a lot of mine are not.
Yeah. And hopefully our conversation was able to shed some light onto this name. Andrew, we'll talk soon.
All right, sounds good. Thanks for having me on.
Take care.
All right, bye.